you are 65 or older, and you are still paying all your taxes the same way you did at 50, you are most likely giving away money that you are legally allowed to keep. I am not talking about loopholes. I am not talking about anything shady. These are actual exemptions written into federal and state law specifically for people your age. The problem is, nobody sits you down and walks you through them. The IRS is not going to call you and say, hey, you do not have to pay this anymore. Your bank is not going to flag it. Most accountants will not bring it up unless you ask directly. So today, that is exactly what we are doing. I'm going to walk you through 7 taxes that millions of Americans over 65 are still paying when they do not have to. Some of these you can stop immediately. Some require filing a simple form, and a few of them could put thousands of dollars back in your pocket starting this year. Stay with me through all 7, because number 4 and number 6 are the ones most people completely miss, and they tend to be the most valuable. Tax number 1, property tax. This is the one that shocks people the most, because property tax hits you every single year and it never gets smaller. In most states, it actually keeps going up. But here is what most homeowners over 65 do not know. Every state in the country has some version of a property tax exemption or reduction program specifically for seniors. Some states call it a homestead exemption. Some call it a senior freeze. Some call it a circuit breaker program. The names are different, but the idea is the same. Once you hit a certain age, usually 65, you qualify to pay less. In some counties, the reduction is modest, maybe a few $100s a year. But in other places, it is significant. There are seniors in Texas, Florida, Pennsylvania, and Illinois who have reduced their property tax bill by over $2,000 a year simply by filing the right form with their local county assessor's office. The catch is, you have to apply for it. It does not happen automatically. Your county is not going to reach out and offer it to you. You have to go to your county assessor's website or walk into their office and ask specifically about senior property tax exemptions. Most of these programs also have an income limit, so if your income is below a certain threshold, and for many retired seniors it is, you may qualify for an even larger reduction than the standard exemption. If you own your home and you are over 65 and you have never applied for a senior property tax exemption, that is the first thing you should do after watching this video. Go to your county assessor's website today and search for senior exemption or senior freeze. You may have been overpaying for years. Tax number 2, federal income tax on Social Security. Most people assume their Social Security check is fully taxable. It is not, at least not for everyone. Here is how it actually works. The IRS uses something called combined income to figure out whether your Social Security benefits get taxed and by how much. Your combined income is your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefits added together. If you are filing as a single person and your combined income is below $25,000, your Social Security benefits are not taxable at the federal level at all. 0. If your combined income is between $25,000 and $34,000, only up to 50% of your benefits may be taxable. If you are married and filing jointly, those thresholds go up. Below $32,000 combined income, nothing is taxable. Between $32,000 and $44,000, up to 50% may be taxable. Now here's the problem. A lot of seniors see a small amount withheld from their Social Security payment for taxes, and they just assume it is correct and move on. But if your total income has dropped in retirement, which it usually does, you may now fall below those thresholds, and you may be having money withheld unnecessarily. You can adjust or stop that withholding by filing Form W-4V with the Social Security Administration. It is a one-page form. You fill it out, you mail it, or bring it to your local SSA office, and you tell them exactly how much you want withheld, including 0 if that is what your income situation calls for. If you are not sure where your combined income lands, sit down with last year's tax return and add up those 3 numbers. It takes about 10 minutes, and it could tell you that you have been overpaying. Tax number 3. State income tax on retirement income. This one depends heavily on where you live, but it is worth knowing, because some states are extremely generous to retirees, and most people do not realize it until they have already been paying for years. 13 states currently do not tax Social Security benefits at all at the state level. Those states include Illinois, Mississippi, Pennsylvania, and a handful of others. If you live in one of those states and your accountant or tax software has been withholding state tax on your Social Security, something is wrong and you need to look at it. Beyond Social Security, many states also exempt a portion of pension income. 401k withdrawals, or IRA distributions from state income tax once you reach 65. Some states exempt the first $20,000. Some exempt more. A few states have no income tax at all, which means your entire retirement income, Social Security, pension, investment withdrawals is untouched at the state level. If you move to a new state after retiring, or if you have never specifically looked into your state's tax treatment of retirement income, now is a good time. Search your state name plus retirement income tax exemption and see what comes up. The savings can be meaningful, especially if you are drawing from multiple income sources in retirement. Tax number 4, capital gains tax on your home sale. If you are thinking about selling your home, or if you sold a home in the past few years, this one is critical. The IRS allows every homeowner, regardless of age, to exclude up to $250,000 of profit from the sale of their primary residence from capital gains tax. If you are married, that exclusion doubles to $500,000. So if you bought your home 30 years ago for $150,000 and you sell it today for $600,000, your profit is $450,000. As a married couple, you can exclude $500,000 of that, which means your entire gain is excluded and you owe zero capital gains tax on that sale. The rules are that you must have lived in the home as your primary residence for at least 2 of the last 5 years before the sale. That is it. You do not have to be a first-time seller. You do not have to buy another home with the money. You just have to have lived there. A lot of seniors who are downsizing or moving closer to family are sitting on significant equity in their homes. If you are in that situation, make sure you or your tax preparer is applying this exclusion correctly before you hand over a chunk of that sale to the IRS unnecessarily. Tax number 5, Medicare premium surcharges. You do not have to pay. Most people know they pay a premium for Medicare Part B. In 2026, the standard premium is around $185 a month. But what a lot of people do not know is that higher income seniors pay significantly more, sometimes 2 or 3 times that amount, through what the government calls IRMAA, which stands for Income-Related Monthly Adjustment Amount. Here is where it gets interesting. IRMAA is calculated based on your income from 2 years ago. So your 2026 Medicare premium is based on your 2024 tax return. If your income was high in 2024, but has since dropped because you retired, because you lost a spouse, because your investment income changed, you may be paying a surcharge that no longer reflects your actual financial situation. The IRS does not automatically adjust for this. You have to request it. You do it by filing Form SSA 44 with the Social Security Administration and documenting the life event that caused your income to drop. If your appeal is approved, your premium gets recalculated based on your current income and the surcharge is removed or reduced. If you are currently paying more than the standard Medicare Part B premium and your income has dropped significantly in the past year or two, this form is worth looking into. Depending on how much your income changed, this could save you anywhere from $800 to over $3,000 per year. Tax number 6, tax on inherited money that was already taxed. This one is more specific, but it affects a lot of seniors who have inherited money from a spouse or parent and are now drawing from those accounts. When you inherit a traditional IRA or 401k, you are generally required to take distributions from it. Those distributions are taxable as ordinary income. But the tax treatment depends heavily on how you handle the inherited account and what type of account it was. If you inherited a Roth IRA, here is something important. Qualified distributions from an inherited Roth IRA are completely tax-free, as long as the original account was open for at least 5 years before the original owner passed away. That means if your spouse left you a Roth IRA that had been open for 5 or more years, you can draw from that account and owe nothing in federal income tax on those withdrawals. A lot of surviving spouses are not aware of this distinction. They see an inherited retirement account and assume all withdrawals are taxable the same way. They are not. If you have an inherited Roth IRA and you have been paying taxes on those withdrawals, talk to a tax professional immediately because you may be entitled to a refund on prior year returns if you filed it incorrectly. Tax number 7, estate and gift taxes. Most seniors will never owe. There is a lot of fear around estate taxes. People hear that the government takes a cut of what you leave behind and they assume it applies to them. For the vast majority of Americans, it does not. The federal estate tax exemption in 2026 is over $13 million per individual. That means you can leave up to $13 million to your heirs before a single dollar of federal estate tax applies. For a married couple, that number is effectively over $26 million. Unless your estate is worth more than that, your heirs will not pay federal estate tax on what you leave them. The gift tax works similarly. You can give up to $18,000 per person per year to as many people as you want without filing a gift tax return and without it counting against your lifetime exemption. So if you have 3 grandchildren you want to help financially, you can give each of them $18,000 this year, $54,000 total, and the IRS does not care. What seniors often get wrong is assuming they cannot give money to family without triggering a tax bill. You can. The annual gift exclusion exists specifically so that families can pass money down while everyone is still alive without unnecessary tax consequences. Now, some states do have their own estate taxes with lower exemptions. If you live in Oregon, Massachusetts, or a few other states, the state-level threshold can be as low as $1 million. That is worth knowing if your estate includes a home, retirement accounts, and savings that together push past that number. Here's what you should do right now. You just learned about 7 areas where seniors are legally allowed to pay less or nothing at all. But knowing about them does nothing unless you act. Here is a simple checklist. First, go to your county assessor's website today and look up senior property tax exemptions. Second, pull out last year's tax return and calculate your combined income to see whether your Social Security should even be taxable. Third, find out what your state does with retirement income. A quick search will tell you. Fourth, if you are selling or thinking about selling your home, confirm with your tax preparer that the $250,000 or $500,000 exclusion is being applied. Fifth, if you are paying a Medicare surcharge and your income has dropped, look up Form SSA 44. Sixth, if you inherited a Roth IRA, confirm the tax treatment of those withdrawals with a professional. And seventh, stop worrying about estate taxes unless your estate is genuinely worth more than $13 million. Most of these do not require a lawyer or a financial advisor. They require about an hour of your time in knowing which form to file or which office to call. If this was helpful, subscribe, because we cover exactly this kind of information every week, the rules, the exemptions, and the deadlines that directly affect your money in retirement. There is a lot more to go through, and most of it will surprise you.